Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for June 1st of 2025. The new month, hopefully all of you had a wonderful May and welcome to the summer. So let's go ahead and get started. So last week we got the second revision of the first quarter GDP number. And as you can see here, it was revised up slightly, but still negative. What we got was a first quarter GDP number that was negative negative 0.2%. And that was versus negative 0.3% in the initial reading, which we got at the end of April. And you can see here, there's the upward revision, if you will. So it was less negative. And here are the reasons why. So, I mean, we had slightly more imports than expected. Government spending was higher than was initially thought, as were inventories. You're going to see inventories probably tail off here in the coming months. A lot of buying ahead of the tariffs. We've got a little bit of a drag from housing versus the initial cut at this, and then business investment slightly stronger. But here is something that is very interesting, and so won't delve too deeply into this this week, perhaps next week. But consumer spending versus the initial read of first quarter economic growth was weaker than had been forecast, and you can see here. Over on the right, we've got consumer spending contribution to GDP growth. And you can see that basically this drag comes from the fact that we had a drop off in goods. You don't see any green here. So, we've got goods spending growth that was basically flat, if you will. It wasn't negative, but it was flat, and we had less positivity out of services spending in the consumer sector. So really, this was a major headwind that was offset by inventories, and so these two things kind of, eventually will reconcile themselves out. But inventory growth, we feel, will probably tail off, and we feel like the net change, now that we've had this number, will probably be less negative here. But it certainly won't, I don't feel, is going to contribute necessarily to a whole lot of growth. And on this chart, to kind of take that one step further, we've got real final sales to private domestic purchasers. We had that number for essentially a couple of quarters tail down just a little bit. So again, I think purchases, consumption, be a little bit sluggish perhaps over certainly the next maybe several months, perhaps, maybe the next quarter or two. Again, that's the prevailing wisdom right now. There's a lot that we don't know with regard to the implementation of tariffs. We've got some kind of tariff updates coming up. But again, there's just a lot that we don't know. This administration is very fluid in its information delivery, and it can change very, very quickly. So in talking about the tariffs, we had the announcement from the U.S. Trade Court last week. It's basically a small three-person panel that judged that some of these specific tariffs due to emergency order as opposed to national security were deemed to be invalid. And so those are marked here in blue on this chart that was repurposed from Bloomberg. You can see that Mexico, China, Hong Kong, some of these that were struck down by the court order. There's a lot of the Section 301 that is still in place with regard to China. But steel, it was announced literally yesterday, I believe, that steel tariffs were going to go up from 25 to 50%. Again, we'll wait to see if that actually happens, but it's a lot of jawboning at this point. But some puts and takes. So there's clearly some tariffs that are still in place, and then some that were held in abeyance by that court order. And interestingly enough, we're seeing from, really just over the course of the month, we had really a trough right there around Memorial Day weekend. And then over the last week, we've actually seen a little bit of strength in the dollar with some of the rhetoric seeming to be toning down just a little bit. And as accordingly here, we've seen with some of the rhetoric dying down, we've seen recession probabilities continue to tail off here. now looking at around 36% probability of recession here over the next 12 months. Again, this doesn't go back very far, maybe about a half month or so, but again, it's just reflective of where the current consensus is. So in the FOMC, basically we've got a Fed that's kind of stuck in the middle here, right? And so if we do have tariffs that prove to be sticky, and there's already impact out there from tariffs, but if they prove to be sticky, then the Fed's going to be concerned with inflation. And you can see here the number of mentions in in the minutes to their last meeting reflected that. And so they want to be very cautious about rate reductions, and you can see that the probabilities have changed dramatically. So at one point, we were looking for something on the order of 75 basis points, back in April when we had a lot of stress in the market and a lot of, fear out there with regard to economic growth faltering. Well, that seems to have died down a little bit as we've been discussing. And so now there's this expectation of only getting for the year, only getting basically 125 basis point cut, and then maybe about a 60% chance of getting a second 25 basis point cut. So they're not even betting on 2 rate cuts at this point, largely because of the inflation fear and the fact that the Fed is really kind of stuck in the middle right now. It is interesting, though, that didn't really get much out of it, but Fed Chair Powell did meet with President Trump, and those two have had a very tense and testy relationship, to say the least. And so, I think Chairman Powell did a good job of articulating the fact that the Fed has to be data driven and cannot go out on a limb and reduce these rates too quickly to help so as to help that inflation along. That's not what they want. Have a regional Fed update here. Very interesting numbers. We've had a bit of a rebound in new orders, although CapEx from the Richmond Fed still relatively weak. But I think we're starting to see some of these expectation numbers begin to modify a little bit, just as we've seen in some of the other data thus far that the tensions with regard to economic growth faltering have kind of toned down a little bit for the time being, at least, and that's reflected in these expectations, even though what we're seeing in current data is still a bit sluggish. Corporate profits is something that we certainly want to pay attention to, and we'll see the correlation into earnings here shortly. But we're looking at for the first quarter, and this is a quarterly number, so this is looking at quarter over quarter, and so we had a 2.9% decline after about a 5% gain in the fourth quarter, and this is kind of reflective of the environment, and this is a big reason why you've seen a lot of publicly traded companies withhold guidance for the remainder of the year. So it's a little bit harder to gauge, where earnings are going to go, but certainly we feel like the trend is going to be sluggish, and I think that's a healthy thing. Again, I do think there's still a bit of optimism, quite a bit of optimism, in fact, built into the market earnings number. If we look at the same data, but on a year-over-year basis, I'd say it's not catastrophic. It's just slowing down a little bit. Whereas, just a couple of quarters ago, we were up at 10% on an annual year-over-year basis, and that's toned down to about 5.5%. So, and this corporate profits number, by the way, is reflective of both public and private companies. But again, the trend line here is not disastrous at this point. It just reflects some slowing, which I think should be very much expected, given the uncertainty out there. So in this chart, we look at specifically the S&P 500 trailing 4-quarter earnings growth. And so the green represents what we've actually seen. And so, in 2024, we've had essentially 4 pretty solid quarters of accelerating earnings growth. Again, the backdrop last year was somewhat favorable. Again, knowing that the S&P 500 from a weighted average standpoint is skewed towards the mega cap companies, particularly in the technology area, which largely had decent years last year, and that is expected to crest here as we kind of like close out the whole first quarter thing, first quarter season here. And this is probably going to be the peak in earnings for a while. So this is a lot of first quarter activity reflected the follow on from 2024. And from here, I think we just decelerate. Then we look at profit margins over on this side. I mean, we've got the expectation that's actually built into consensus estimates looking into the next several years that we're going to have accelerating profit margins that are going to go from around 13% to 14%. And I feel like that can happen, but to bet on that is perhaps a fool's game. I think at best we'd like to see something that is anchored in this 12 to 13% range. And you've heard stories on these tariffs where some of these suppliers are going to basically eat the margins, basically eat the cost of the tariffs and not pass it along to customers. Some people are, but I think in aggregate it's tough for me to expect this environment when I would probably expect at least this and maybe a slight degradation until we have some real clarity on tariffs, or when we get to the essentially the 2028 elections. Talk a little bit about the labor market. This is net job gains as we're looking here in May. We'll get this number next week. The 1st of June is when the Labor Department reports this. And again, just like we saw with earnings, this is probably going to be a bit of a peak here in the first half of the year, and we see some net job gain decline over the next several months. And I think just like we see in earnings, it's going to be the second and third quarters that at this juncture, based on what we can see right now, is probably going to be the most sluggish period in terms of job growth, which again is one of the Fed's mandate. So stable prices being the other. So we just talked about that a few slides ago. And the labor market, this would be the causal factor. And you see net job growth go from 150 down to something around 70-ish. It generally is accepted that you need about 100 to 120,000 jobs per month to satisfy the growth in the labor force. So anything below that is certainly going to get the Fed's attention. And this is probably where we get the impetus for that, kind of that 1 to maybe 2 rate cuts this year if we see market slowing in the labor market, but with an inflation environment that isn't accelerating. Here we have a little bit of a busy chart. This is essentially the outcome, the interim outcome of the budget talks as they exist right now. And so there's a lot of contention. In fact, I think I included this in the last chart pack, but there are savings coming from various things that are being offset by the extension of the tax cuts, which is a big source of contention for minority faction of the GOP that is dead set against expanding deficits, which are already pretty high for non-recessionary periods. So you have these gains where you're cutting some things and student loans, some subsidies for certain things, and some changes in energy allowances that are also down here, that also are other tax offsets here. There's a whole bunch of stuff that goes into this, so I won't go into it. But basically, this is just kind of a waterfall showing you that you've got some gains from savings that are in tax hikes, in this case, that are going to be largely offset here by the extension of the tax cuts and new tax cuts and spending hikes in Homeland Security and Defense that are going to exacerbate our deficit. And this is going to be an issue that we're going to have to wrestle with in the coming years, is this increasing deficit, particularly during non-recessionary periods, because it really doesn't make any sense, especially if you're under kind of the Keynesian economic theory that, why would you expand your deficit or feel the need to when you're not in economic contraction. Interesting data point here. We've got data center investment. We've talked a lot about this being a very strong point within the corporate spending market. Now we've already talked a lot in the last month or so about capital spending expectations going down. We saw a chart earlier from the Richmond Fed that those expectations are still in the doldrums. But here, we've got a big jump in data center investment, and this is actually a chart that shows the contribution to real GDP growth. And we've seen, over a long period of time, where data and storage has been a net beneficiary to economic growth, and maybe a little bit less so, like marginally positive here. But that has really accelerated. Now we're almost basically one full percentage points of GDP growth coming from direct investments in data centers, which we know are largely tied to AI. We have a housing market, interesting data point here. We've been watching mortgage rates for some time. I had another chart that was a little bit more specific. We're just under 7%, and you can see that this is kind of range bound, and obviously it's indexed. 30-year fixed rate mortgages are indexed to the 10-year U.S. Treasury, and I do feel like those rates are pretty well anchored. So I see this kind of continuing here. But this is the more interesting point. And we talked a lot in 2022 to 2024 that overall average mortgage rates were below 4%. Well, that's no longer the case. And you can see that the average mortgage rate in existence now is creeping up. And so there's less wiggle room and more potential impact on the consumer as people have to move for job reasons, or you've got first-time home buyers and such, that this average is going to continue to creep up. So as long as we've got these rates up here, and if these persist, then you're going to see that average rate continue to move higher. Got pending home sales, which were down quite a bit, much lower than expectations in the April survey reading. You can see that there are basically 500,000 more sellers than buyers, and this is a gap that doesn't show itself very often. We saw it back here in 2014, 2015, 2016, and we're actually getting back to, if not exceeding, that gap here in terms of the delta between those two. So housing market driven by lack of affordability is still an issue. Existing home sales, month supply, you do see that inventory is picking up. This was, I think, arguably very unhealthy back here post-pandemic, and we've talked a lot about that. Inventories gotten back a little bit, to more normalized areas, but have certainly spiked as of late this year. Again, driven by the affordability issues and the desire that, certainly the sellers market here being well entrenched. Conference board CEO surveys. We've talked a lot about CEO sentiment and how it's reflected in earnings calls, and we do pay attention quite a bit to what goes on in terms of the conference calls and what's being said and kind of the inflection in the voice, and so to speak. CEO confidence, not too surprisingly, has taken a fairly sharp nosedive because of what happened in April with the tariff announcements, and just the sense of caution and marginal anxiety that persists out there on the part of corporate America. And you can see here, what are the drivers between that? And we've got first and second quarter data here, first quarter being in the gold and second quarter here being in the blue. And you can see not much has changed except for this trade and tariffs. So this is largely an April and May phenomenon. We came out of first quarter. There's certainly the knowledge that Trump was interested in tariffs, but he hadn't really made any strong and bold announcements on that yet. And April was a month for that. So you can see that suddenly jumped up into becoming basically a real main risk issue on the part corporate executives. Geopolitical instability is right up there, as well as uncertainty of different flavors, cyber, financial, economic risks, and some of these things which have persisted for some time. Health risks, supply chain, energy supply, so on and so forth. And but these are the main things right now: basically uncertainty, tariffs, and geopolitics. Richmond Fed manufacturing. Actually, this we didn't have this in the Richmond Fed data that I just showed you a few slides ago, but wanted to come back to it. That we've got prices paid, which we reported basically about a month ago that really spiked, and that caught our attention. It has eased off a bit, still relatively high in terms of the aggregate sense. Still kind of in the upper single digit category, largely speaking. So this is still an issue, even though it seems like we've the prices paid expectation number has kind of come off its peak. Here we have durable goods new orders year over year. Really not in bad shape. I mean, this is the hard data, versus the soft data that we've talked about. Soft data being sentiment, hard data being this, right? I mean, this is what's in the data. Now, we came off an interim peak, but again, the trend line data is not necessarily bad. This is year over year data. And you've got in the amber line here, or gold, whatever you want to call it, this is X transportation, which tends to be less lumpy, less volatile. And as you can see here, it maybe tails down a little bit if you spend a lot of time with this chart, but it's not in catastrophic territory. Again, hard data is not reflective of what's going on in the soft data right now, at least not yet. Bankruptcy index, again, no huge worry here. We're looking at trend line that is pretty close to the longer term, really multi-decade trend line here. So again, no worries there. Again, this is hard data. Again, not reflective of what we see in the soft data, the sentiment numbers. Consumer confidence, labor differential. This is just basically jobs plentiful versus jobs hard to get. And again, labor market continues to soften up here. It's not terribly surprising. And again, very much expected at this juncture. Here we have a quick check-in on the energy markets. Interestingly enough, we've had crude oil inventories, gasoline, and all of the distillates. All of those inventories have come down at a point where we've seen Brent crude at least kind of hold near its trend line. This is their 50. This blue line here is the 50-day moving average, and we're holding pretty close to that. So with these inventories dropping, I would expect probably prices to at least be continued to be firmed here at the $65 a barrel level, if not move slightly higher, especially as we transition wholeheartedly into the summer driving season. We've got gold. We've got gold price, and I thought this was very interesting because we talked about the dollar showing a little bit of renewed strength, and this goes back to 2000. So it does have some trend line and some statistical relevance here, and you can see if you are to invert the U.S. dollar trade weighted index here, the TWI, in that red line, you can see how well it correlates to gold prices. And this is very, very interesting here. So, we've had a surge in gold, which has corresponded with a relatively weak dollar. And again, if you feel like the dollar is going to remain a little bit challenged because of tariffs, then you would expect gold prices to really hold their head in here quite a bit. And you can see dollar weakness here is reflected in some of these trend line indicators that are coming out of Alpine Macro. Down here, you see the dollar index rolling over as we see the cyclical growth indicator of the United States rolling over relative to the rest of the world. This is one of the reasons here in 2025 that we've seen such relatively strong performance out of Europe and some of the international sectors versus the US. It's because we've got these growth indicators for the US that are not looking as comfortable or necessarily looking as strong as the international ones. And so that all ties back to the dollar index down here, which also ties right back to gold strength down here. Percentage of stocks that are outperforming is very interesting. So for multiple years here, we were dealing with the Mag 7. So stock market index performance was driven by a very, very narrow set of very large companies that had a strong weighting in the index. And so that has given way, at least through the end of April. And we see that the average is pretty close to 50. It's actually 49 here. The average is that just about half of the stocks in the index outperform it, which, if you go back to 1990, then that probably should make some sense, right? But here we see that more stocks are participating. This is increased breadth, which is positive for a lot of different reasons. But if you're looking for kind of sustainability of index trends that aren't subject to the whims of a very small number of companies, then we're getting more of that this year. So here we have defensives as a percent of the S&P 500. So think of defensives as like Kimberly-Clark, staples, and companies that have very strong competitive positions, some companies and industries like consumer staples that you're not going to have a significant change or inflection in demand given changes in economic growth. But this is not what the market has wanted over a period of number of years, and this just being the pandemic year. You can see that trend was already in place prior to the pandemic, and you can see going from call it an average even pre-pandemic, like 2017, that average was closer to 27% defensives as a percent of the overall S&P. Now, with the increase in concentration of the very large mega cap technology stocks, this has dropped for a lot of different sectors, including financial. But you can see that number is down close to 18 versus this average of 27%. So very interesting development here, which in turn has made the S&P 500 a more volatile index overall. So we have retail flows and we have foreign inflows into the U.S. stock market. And this is something that I have not expected to see, but it is trending this way. So we saw an initial reaction to a lot of the tariffs and some of the, I guess, the intentions on investment in the U.S. that went down because of the prospective high tariffs that were going to create a lot of trade barriers, and it obviously and naturally irritated a lot of countries and investors in those countries. And I thought that this number would be pretty weak, but it's actually remained pretty strong. In fact, we're on pace here for at least foreign inflows to U.S. equity markets being a record year potentially. And then offsetting that is that you've got retail flows that have moved down and in a net way. So again, a little subdued performance internationally, but once again, our U.S. markets are supported by positive international money flows. Couple of charts here on the private markets. What's interesting here, we've got institutional investors. Basically, 2/3 of institutional investors plan to increase their allocations over the next 5 years. And where are they going to do it? Like private infrastructure, which we talked about data centers before, but this goes beyond that. It goes into utility systems. It goes into a lot of private infrastructure that is not roads or utilities, and you've got private credit down here, which is kind of that non-bank banking sector. And so you see here either increase in the blue. You've got basically half of those institutional investors that are going to flat increase, and then you've got a pretty sizable number here that are at least going to maintain. And so very few are going to actually decrease or not invest. And private equity is up there too. Private real estate, which we haven't talked a lot about, but you've seen a kind of a shift in the investment sphere as you've seen non-bank funds kind of take the lead from some of the banking, commercial banking sector. And then also here we've got private placements that have also increased their representation. So you do see private markets becoming a greater percent of portfolio allocations overall. We have seen that over the last couple of years, and we expect to see that trend continue. So public credit markets, this is a little bit of a check-in here on fixed income. And no stress here whatsoever. This is the green represents investment grade corporate spreads. And this would be the spread of the yield on the corporate to the yield of the deemed to be risk-free rate, which maybe not so much risk-free anymore, but the U.S. Treasury. And you can see that those spreads are pretty tight and they're below their longer term averages here. And so there's really no stress whatsoever being evidenced in the credit markets, which is one of typically the first places that you would see it if the overall markets were beginning to fear an economic downturn. Here we have 73% of the bonds trading at less than a 5% yield. I thought this was exceptionally interesting. So, you know, after all those years of having very low interest rates and the concentration of outstanding paper, particularly in longer maturities, continues to kind of keep this number high. But we would certainly expect as rates are higher and continue to remain higher that we'll see maybe a decrease in this number over time, but still a lot of paper that is well below 5%. And finally here, last chart, we've got private equity fundraising, which we just saw that a couple slides ago that the allocations for institutional investors are likely to go up. However, fundraising has slowed down and venture cap momentum has slowed down a little bit too. Again, for a lot of different reasons, uncertainty being really kind of almost top of mind. So what's interesting here in this dynamic, and I should have put these charts back to back, was the fact that you've got increased demand for this type of product, as we saw a few charts ago for institutional investors. But right now we're having a little hiccup in supply. And so, you know, what that means is that exit values and secondary values, because there is increased demand, are likely to actually go up for secondaries in particular within the PE space. That's all we have for the chart pack this week. I hope you've enjoyed the insight and have a great week, and we'll talk to you again soon.